Hello and welcome today. My name is Yasir and I'm your tutor for today's session, Advanced Project and Logistics Management. Hi, Hatim, can you see my screen and can you hear my voice?
Yes, I can.
Okay, just can you introduce yourself a little bit, what you're doing and
So my name is Atim bin Ahmad, and I'm a software developer currently doing a job in
okay,
front-end development.
okay. So you are based in UK
No, I'm based in Pakistan.
or you are from Pakistan? Okay, okay,
Yes,
that's
yes.
good. Okay, Hatim. So you are trying to do something. Is it related to your job basically or project
Yes,
management?
yes. So project management is also part of my field. So basically, you can integrate project management and software development. If you combine these two, it makes a technical project manager. So that is also a field. Hence, I chose this course.
Okay, all right, okay. Okay, so our today's session, we will discuss the fundamental concept that distinguish these three critical areas of management within the context of project management. On project, program, and portfolio management. So understanding these concepts is essential for effectively managing resources, aligns project and strategic goals, and ensuring the successful delivery of outcomes. Okay,
Oh.
so you can hear my voice clearly, huh? If
Yes,
there is
yes, I
any
can.
issue, please let me know. Then I will try to sort things out. Okay.
Sure, sure.
Indicative contents throughout the unit, we will focus on the areas like how portfolio management aligns with organizational strategy, ensuring that projects and program support strategic objectives. So the importance of a portfolio roadmap in guiding decision making and prioritization will be emphasized. Uh, Compare the features and aims of program and project management, program management with project management. Any comments on this or any idea about project and program management?
So basically, if you're a lead of a team and you have to manage a project, let's say a product, I think it's related to that.
Yes. S- Basically, projects are essential for introducing change. They are used to develop new products, systems, to modify the physical, social, or cultural environment. So the word project is derived from the Latin verb, this is basically basic definitions, which means to through forward, symbolizing a leap into the future, according to, NOCAS, the international standard organizational defines a project as a set of coordinated activities with a specific start and finish. So aiming to achieve a defined goal while working with constraints related to time, cost, and resources. So similarly, Phil described a project as a sequences of interconnected events conducted over a limited time with the aim of producing a unique, well-defined outcomes. We will look further as well.
Yes.
So, is it your first module? Just asking Hatim.
Yes, yes. It's my first
Oh,
class and my
okay. No,
first
no. I mean,
module.
is it
Yes.
your first module? Because there are, I think,
Yes.
5 modules in diploma.
Yes, yes. This is my first module, I
Oh,
think.
okay, okay, okay. So basically, project management's here you can see slides, but I will just try to explain in my own words. Okay.
Okay, okay.
So, uh, Project management basically refers to application of various management skills and techniques aimed at successfully completed a project. So, Barbara Allen, you can see here, it says that describe project management as involving several key activities, including thinking ahead, conducting research, planning, sequence of activities, managing both people and resources, monitoring program. So these activities ensures that project proceeds smoothly, meets in objectives, and handles any challenges that arise during the process. Here, project and program management. Uh, Program management coordinates both projects and ongoing business activities to achieve beneficial changes. Program is a unique strategic undertaking that integrates several related projects and regular business operations. uh, Within the ultimate goal of delivering long-term benefits to the organizations. Programs are typically large-scale endeavors aimed to achieving significant change or improvement. Uh, Program management may include several projects working together to create change in coordinated and strategic manners. So program also have the flexibility to adjust or to changing circumstances as they focus on maximizing benefits over time. All good, Hatim, so far?
Yes, 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 yes.
Okay. Delivering uh, program change. Programs are often seen as tools for delivering change, especially in complex or evolving environments. They aim to achieve long-term benefits by using capital expenditures to acquire necessary essential services or products, while also utilizing operational expenses incurred throughout regular business activities. A program typically delivers benefits incrementally over time, shaping its structure and adopting its approach to achieve the desired results. The the distinction between projects and program has often been misunderstood or ignored. You might heard about Project Management Institute based in USA and UK as well. So according to PMI, a project is chartered to produce a specific deliverable as efficiency as possible. On the other hand, programs are designed to coordinate multiple related projects and activities over time to achieve long term. For example, of the confusion between a project and program can be seen in the historical, Manhattan Project, which aimed to create two different atomic bombs. This, endeavor involved the construction of factories and the operations of these plants, activities that make uh, so uh, uh, these plants activities that make it more accurately described as a program rather than a project. So the Manhattan Project was a faceted undertaking with numerous interrelated elements, making it is uh, uh, a classic example of a program management. Disaster relief efforts also provide a useful example. Often referred to as projects, these initiatives are in fact ongoing programs aimed at achieving a return to normality. So these efforts involve numerous projects and operational works elements which must adapt to evolving circumstances, much like any other program. I will go a bit further here. So defining the differences, project or program, the defining standards. Uh, According to PMI, Project Management Institute, and the OGC, OGC is Office of Government Commerce. So according to the PMI and Office of OGC in the United Kingdom, organizations manage multiple portfolio projects. Each portfolio contains several programs and projects. Portfolio management focuses on selecting the optimal mix of projects and programs based on the organization's available funding and resources. Uh, Program management, in contrast, is concerned with coordinating related project to deliver long-term benefits for the organization's project uh, with program must be efficiently managed to ensure that they contribute to the program's overall goals. So, all good, Hatim?
Yes, yes,
Everything is okay?
yes, yes.
Okay, good. Basically, you know that project management is, I believe, is not very boring, topic, or is not a very boring field. It's a really good, uh, uh, and nowadays, the different project management certifications as well. Uh,
Mhm.
Prince 2, have you heard about Prince 2 and foundation and practitioners as well?
No, no.
Yeah, Prince 2 basically project in controlled environment. Okay.
Mm. Okay.
So yeah. So it's a most that commonly used in companies and firms around the globe, especially in Europe, UK, and US.
Okay. So is
So
it a method or
it's a
a tool?
certification. Basically,
Oh, okay,
it's
it's a
like a
certification.
certification. It's
Okay,
so
okay,
yeah. So I hope this diploma will be helpful for you.
okay,
You can complete your master as well. You know that
okay.
after diploma you can write an dissertation
Yes,
to
yes.
complete your masters as well. I think so. You can uh, uh, do it in Pakistan as well.
Okay, okay.
So PM book fourth edition defines a project as a temporary endeavor aimed to producing a unique product, services, or result. Projects have a defined starts and finish and closed once the work in completed. Programs, on the other hand, are described as a group of related project managed in a coordinated way to obtain benefits that could not be achieved if the projects were managed individually. Programs may also include activities beyond the scope of individual projects. OGC standard has a similar perspective on the distinction between projects and program. Here, can you see here this one?
Yes, yes. Prince too. Yes,
Yeah, Prince
that
2
was.
just.
Yeah, yeah.
So Prince 2 project management focuses on management of individual projects while the managing successful program. This is also a certification or methodology. MSP, management successful program.
Okay. Just like
Defines a program.
Prince too.
Yeah, it is like
Okay.
a Prince 2, but bit advanced. You
Okay,
can
okay,
say next edition or updated, version or things like that.
okay, okay.
But they're not Prince 2, there are only two parts or two stages, Prince 2 Foundation and Practitioners. So
Okay.
MSP is a different, like a project management practitioners managing successful program and foundation and advance, something like that. Okay. So you can
Okay.
say it's like a two different series. Okay.
Right.
But most of companies or most of organizations looked at Prince 2.
Okay.
So portfolio of project and activities coordinated and managed as a single unit to achieve long-term outcomes and realized benefits. Standardizations program is defined consistently across various contexts. It involves managing multiple projects together to achieve benefits that could not be obtained from managing the projects separately. A program objective is to realize outcomes, which is a very different goals compared to projects. Project typically focus on efficiently delivering specific products, services, or results known as deliverables. This difference in focus is often summarized by stating that projects create outputs, whereas program delivers outcomes. Concept of multiple decision team discipline team is crucial in product development. A multiple discipline team consists of individuals from various functional area, all working together with the shared goals to develop a specific product or set of products. So this approach ensures that special specifications, design, production, deployment, operations, and maintenance are integrated concurrently, leading to a greater efficiency. Principle of portfolio management. Principle of portfolio managements are essential for aligning organizational strategies with project and program outcomes. One core principle is the alignment of strategy, ensuring that the portfolio of change projects matches the broader corporate strategy. Governance must also be aligned to support the portfolio effectively, ensuring that projects are being governed in a way that benefits the organizations. Another principle involves confidently closing projects that will not deliver the intended benefits, ensuring resources are not wasted. Active leadership is another key principle, with strong leadership needed to guide the entire portfolio structures. Okay, all
Okay.
good. Any questions so far?
No, no.
Okay, okay. So portfolio management. Any idea about portfolio management? Any comments so?
So basically, I think what my initial thoughts are, a portfolio of a product or company, what the company stands for, and what the product will bring to the market. I think it's about that.
Yeah, it is something like basically uh, portfolio management refers to the process of selecting and overseeing a group of investments, okay, that meet the long-term financial goals and risk tolerance of an organization's client or institutions. It requires skill in weighing the strengths, weaknesses, opportunities, and threats of various investments. So the goal is to balance trade-offs between factors such as debt versus equity, domestic versus international investments, and growth versus safety. Okay.
Okay.
Uh, Portfolio management can be conducted by professional licensed portfolio managers. I don't know about there, but it's a very common, it's a very common, what I can say,
Practice?
portfolio management is a very
Yes.
common in banking sector specifically,
Okay, okay, okay.
investment banking and financial advisors and mortgage advisors, or it's a very common, posts or designations or people working as a portfolio managers.
So, okay, okay.
So licensed portfolio managers or individuals managing their own portfolios. In both cases, the ultimate goal is to maximize expected return while keeping risk within acceptable limits. So to understand portfolio management, may be passive or active. Passive management is long-term strategy where investments are held over time, often through exchange traded index funds. This is commonly called index investing, where modern portfolio theory may be applied to optimize the mix of investments. If we talk about active management, on the other hand, involves making frequent investment decisions, attempting to outperform market indices by actively buying and selling individual stock and assets. Active managers may rely on both quantitative and qualitative models to make informed decisions. However, trying to outperform the market inherently involves additional risk, particularly due to human decision making in stock selections. Key elements of portfolio management, assets allocation. So one of the critical element of effective portfolio management is asset allocation, which refers to how investments are divided among different asset classes, such as stock, bonds, and cash equivalents like certificates and deposits. Other assets classes such as real estate, commodities, and derivatives may also be included in portfolio as alternative investment. So asset allocation is grounded in the understanding that different types of assets do not behave the same way. So some are more volatile than others, and the movement of markets in various assets classes often differ. By having a mix of assets, a portfolio can achieve balance and reduce risk. Diversification uh, is another key concept. It refers to spreading risk across different investments which within the same asset class, since predicting which sector or subset of an asset class will outperform other is nearly impossible. So diversification aim to capture the return of all sectors over time while minimizing volatility. So diversification should be applied across different type of securities, economic sector, and geographical region. Rebalancing a, a portfolio is essential to maintaining the or original target allocation of assets. Over time, market movements can shift the balance of assets in portfolio. Uh, for example, if portfolio industry has a 70% allocation to equities and a 30% allocation to fixed income investments, and extended market rely could result in an 80-20 allocation. So while this shift may result in gains, it also introduces more risk than the original allocation intended. So rebalancing involves selling over valued assets and reinvesting in undervalued ones to return the portfolio to its initial risk return and or return profile. Active portfolio management involves This active portfolio management involve fund managers or brokers actively making investment decision with the goals of outperforming a specific market index such as the Standard and Poor's 500 index or the Russell thousands index. So these activity managed funds are run by individuals, portfolio managers, or uh, teams that use research, forecasting, and market expertise to decide which investment to buy or sell. So active portfolio managers closely follow trends in the market, changes in the economy, and political development to market informed decisions. Passive portfolio management, often termed index fund management, is strategy aimed at replacing the return of a specific market index or benchmark. Managers of these portfolio purchases the same stocks that comprise the index, adhering to the same weighting represented within that index. So this method of investments allows for broad market exposure without the need for active management decisions. Examine the difference between a program and portfolio. Um, Again, it's the same. Portfolio management encompasses a grouping of an organization's projects and programs. So this grouping may be based on various factors such as geographical location, capability, or customer type, tailored to the specific circumstances of the organizations. So the process of portfolio management involves selecting, prioritizing, and controlling projects and programs in alignment with the organization's strategic objectives. The portfolio manager is responsible for determining which projects or program to undertake, allocating the necessary resources, ensuring their efficient use and activity, pursuing benefits. Accountability for delivery lies with the managers who reports directly to the executive boards. Uh, Also, program management uh, consists of a group of related, projects and change management activities are designed to deliver beneficial outcomes. This grouping approach allows the better oversight and prioritization of resources, achieving economies of scale while minimizing duplication. It also facilitates the management of interdependencies among projects, coordination among stakeholders, and effective communication, leading to enhanced share of lessons learned. Uh, the program management, so the program manager is critical, requiring them to focus on the broader perspectives rather than getting bogged down in day-to-day deals. Responsibilities including overall planning of the program, coordinating management and control of the project, prioritize resources allocation. Projects are defined as unique transit endeavors that aim to achieve specific objectives. Uh, each project is characterized by its uniqueness, time constraints, specific cost, defined scope, acceptance criteria, and inherent risk and uncertainties. Projects are typically managed by dynamic terms that come together for a limited duration, comprising specific specialists who contribute as required. Then stakeholders, uh, governance structure, and risk factors play a significant role in shaping project outcomes, often impacting the so-called iron triangle of time, cost, and quality. So project management employs a variety of processes, methods, and training, leveraging the knowledge and skills of the project managers and the team to deliver the expected outputs. Project emphasize output are less complex, have specific starts and end dates, adhere to an agreed total budget and process defined scopes, generally involving lower risk. Effective governance is crucial for the success of project and hinges on four foundational pillars. First, portfolio direction must align with the organizational strategy to ensure that projects contribute to overreaching uh, goals. Second, the right sponsorship is essential for securing support and resources. Third, project management effectiveness is determined by the availability of tools, techniques, and trained personnel capable of executing projects efficiently. And finally, uh, transparent disclosure and reporting are vital, allowing for open communication about success and challenges and facilitating requests for assistance with necessary. Portfolio roles, effective management, portfolio manager, obviously, structure of portfolio role is starting with executive management at the top, followed by the portfolio manager, and then branching out to including various projects and program. So this structure ensures that there is a clear line of responsibilities and accountability from executive management through to individual project managers. Okay.
Okay.
Any
I have a
questions?
question. Yes, yes.
Yes, Satin.
So I have a couple of questions. Firstly, how do managers ensure that the quality is up to the par set by the company or the project initially? So first question is quality control, and second question would be, uh, how do you or how does the manager plan or tackle risks that happen during the project?
So project
Unexpected
management,
issues. Yes,
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 the project management is not based on a one person. As I
yes,
said,
yes,
there is a team. Okay.
yes, yes,
So first, when you deal with any project, there are two things. Okay. First, you
yes,
ask about how to deal with the risk, and then how to ensure that quality limitations. Okay, or it's
yes,
up to standard. Okay. So secondly, how to deal with the risk. Okay.
yes,
So when they execute any project, okay, there are two things. There are in a project management, there are different person or different departments who deal with the different areas. Like there is, I don't know about if look at your company, might be there is a quality control department and they are dealing with the project. When they execute project, there is a complete team. They deal with the risk, they deal with the quality, and there is a
mhm,
set standard by that by quality department or company policy. Let's say, uh, for example, I give you an example of car companies. Okay, I used to work for have you ever heard about Caterpillar?
no, no,
Okay, Caterpillar is they build heavy machinery,
okay,
construction machinery. You might seen a bulldozers and
yes,
in construction industry. So there is a clear quality policies, a zero defects. Okay, when they talk about quality, they execute
okay,
projects, there is a zero defect policy.
so, okay, okay,
Okay, you understand now quality? So that policy,
yes,
it works like that. They make sure when they execute project, when things comes to the quality, there should be the quality standard is zero defects. Okay, that's the standard. Okay, so every
Right.
company has their own standard. Okay, might be some companies thinks that, okay, oh, this is not a defect or this is not an issue, so we can move on. But some companies, as I gave you example of Caterpillars, they will not move unless there is a zero defect policies not implemented. Okay, hello.
Yes, yes.
Yes. So,
Yeah.
Hatim, this is the way they work when they execute project. Like if you get a chance, look, go through you might have on your, learning management system, you might see there. If not, then go through, Google it and go through the prints too. You will see a different, areas, how when execute project and ending project. So there are two sections which are
Right.
quality and risk managements. Risk, how to deal with risks. They when they go through the execute projects. So team risk management team already, let's say they assume these kind of risks can be occurred. Okay,
Yes.
we can face these kind of let's say when as a developer, when you do something, you can think there are this kind of risk, that we can face, and this is its alternative. So there are risk managers, or alternatively, there are risk managements who can handle. They're a part of project management. They are project managers who deal with the risks. Okay,
Right.
in different stages. Obviously, whenever you start any project, let's say if you start a building, okay, and there is a risk that might be a shortage of any parts or anything else. Okay, so you can deal with that risk. You can contact with other. You might have any other alternative. You have a reserve stock, or you might have you know or emergency contractors or companies to deliver your stock or stuff like that. Okay,
Right.
is that clear, that or any?
No further questions. Thank you. And the explanation was good. Thank you.
So this is a main things. Quality is a standard which is set by companies. I just will quickly go through. And one standard is when any projects, there is and every company set their own standards. Okay. So this is our level, or this is our set standards. We'll go up to here. Okay.
Right.
Or sometime when they do project, there is international standards, that's a deep discussion, like ISO 9001, or when they go through that, they deal with everything.
Right.
So but there are a quality, when project goes to a quality department, when they come execution, and then they work on it, and then when they go to quality or risks, they look at everything.
Yes.
Right. So, portfolio projects and program, as I said, portfolio strategic grouping, focus on maximizing return on investment, balanced mix of project, ongoing high risk. Project is focus on, sorry, program focuses on outcomes, higher complexity, long time scales, higher budget, scope is less defined, high risk. Project focus on outputs, less complex, defined start and end days, aggregate total budget, defined scope, less risk. What is portfolio? Portfolio can be defined as as a grouping of an organization's project and programs, which can be managed at either an organizational or functional level, as stated in the APM body of knowledge. APM is, you might heard about APM. It's a Association of Project Management. So it's a body of knowledge. Grouping is often based on various criteria, including geography, capability, and market positioning. So the design of portfolios should focus on maximizing return on investment while adding in the control of costs and benefits. So this involves balancing a mix of high and low risk initiatives and including both novel and repeat project to create an effective portfolio structure. Business strategy. Business strategy encompasses the long-term goals and objectives of an enterprise alongside the adoption of actionable courses and the allocation of resources necessary to achieve these goals. So, as defined as Alfred Chandler, Michael Porter emphasized that competitive strategy involves being distinct and deliverability, choosing a unique set of activities to deliver a distinctive value mix. So Henry defines strategy as a pattern emerging from a series of decisions, while he also described it as the long-term direction of an organization's. Few things are just there sometime, that repeating or the defining in more depth. So portfolio management defined, portfolio management entails the selection, prioritization, and control of an organization. So a projects and program in alignment with its strategic objectives and capacity to deliver. The primary goal is to balance change initiatives with a routine business activities while optimizing return on investment as outlined in the APM body of knowledge. So in the role of decision making, the portfolio manager must determine which projects are programs to undertake. As a resource management, the aim is to maximize the efficiency of available resources. Additionally, as a productivity driver, the focus on is on ensuring effective and efficient delivery. Finally, as a benefit chaser, the portfolio manager is tasked with realizing all potential benefits from the undertaken initiatives. Evaluate the efficiency of various portfolio selection tools and techniques. There are, portfolio encompasses a collection of investment vehicles, which may include stock, mutual funds, bonds, and cash. So the composition of an investment portfolio depends on various factors such as income, budget, and the time frame which within which the investments are intended to be realized. Each investment within a portfolio is selected based on its potential to achieve the investor's financial goal while considering risk tolerance. Market portfolio, if you see here, this represents a theoretical construct that consists of every assets available in the financial market. Zero investment portfolio is defined as a combination of investment that when aggregated results in zero net value. This can be achieved through transactions where equivalent securities are budgeted and sold, allowing investors to hedge funds or hedges against potential losses without requiring an initial capital outlay. Uh, Meaning, portfolio management refers to the art and science of selection, the appropriate investment policy tailored to an individual's financial circumstances. So the primary goal is to achieve maximum returns while minimizing risk. So effective portfolio management not only protect the principal amount but also aim to enhance the purchasing power of investments over time. So needs of portfolio management, basically, the necessity of portfolio management stems from several key factors like a risk reduction. It mitigates risks without sacrificing potential return. Rational decision making uh, facilitates informed investment choice based on through analysis. Optimal assets selections identify suitable assets classes for investment. Establish the allocation of specific securities within those asset class. So here are some safety of principal amounts, investment, disposable income, growth of capital, marketability, liquidity, a well diversified portfolio, and minimal tax burden. Objectives of portfolio management. So safety of, I'll quickly go through one by one. So safety of principal amount, ensuring the preservation of capital while contribution to its growth is crucial for maintaining the purchasing power of investment. Investment of disposable income, investments often aim to allocate their current wealth into securities while establishing mechanisms for future income investment. Growth of capital. Portfolio management is structured to ensure capital appreciation, typically achieved through reinvestment in growth securities. This strategy protects investors from erosion in purchasing power. Marketability, investment selections should include securities that can be easily marketed and traded, with the preference of for those listed on major stock exchange. Liquidity, it is a vital for a portfolio to maintain sufficient liquid assets to meet the investor's short-term financial needs. Well-diversified portfolio aims to reduce the risk of capital loss or income reductions through strategic investment in various securities. Uh, Here is important to note that no investment is entirely free from risk. Effective portfolio management, consideration tax implications, aiming to optimize yield by minimizing the investor's tax burden. Here, a phase of portfolio management, security analysis, portfolio evaluation, and portfolio analysis. When we talk about security analysis, this initial phase involves a comprehensive evaluation of various types of securities, including equity shares, preferences shares, debentures, and other financial investment. Portfolio analysis. In this phase, the risk and uh, here in this phase, the risk and return associated with each security are analyzed both individually and collectively. As a part of a portfolio, multiple portfolios are compared to identify the best investment options, examining different combinations of securities and their respective weightings. Then I'll see here portfolio selections, portfolio revision. Selection is this phase focuses on selecting securities that aim to provide optimal return at a given level of risk. It involves identifying one or more efficient portfolios from a broader set of alternatives. Portfolio revisions, continuous monitoring of the portfolio is essential to maintain its optimal configurations. Changes in the economic and financial landscape may render certain securities less attractive or reveal new opportunities for investment. Then systematic before here a portfolio revision, uh, continuous monitoring of the portfolio is essential to maintain its optimal configuration. But here is a evaluation as well. Uh, Portfolio evaluations is a process that involves assessing the performance of portfolio in terms. So the final phase basically entails assessing the portfolio's performance in terms of risk and returns. The evaluation includes measuring the risk experienced by the portfolio over time and quantifying the actual returns generated. So then systematic risk arises from broader economic, social, and political changes that impact the overall market. It encompasses several dimensions. For example, interest rate risk, market risk, purchasing power risks. So interest rate risks predominantly affects the debt security market, where fixed interest rates can fluctuate based on broader economic conditions. Then market risks reflects the inherent volatility in stock prices due to market forces. Purchasing power risks results from inflation, which can erode the purchasing power of investment returns. Unsystematic risk. There are two type of unsystematic risk linked to specific microeconomic factors that affect individual securities. This type of risk uh, occurs in addition to systematic risk and includes business risk and financial risk. So business risk arises from operational challenges and changes in the business environment. Financial risk relates to fluctuations in company capital structure impacting its financial stability. Assets allocation strategy is critical for optimizing a portfolio performance. Various or approaches, including if you see here, strategic asset allocation, integrated asset allocation. Strategic asset allocation involves periodic assessment of returns, risk, and conveniences associated with the portfolio. Integrated assets considers capital market conditions alongside investor objectives and constraints for more informed decision making. Then tactical asset allocations maintains a constant risk tolerance while adjusting the asset mix based on market expectations. Insured asset allocations adjusts risk exposure based on changes portfolio values, increasing risk capacity as portfolio values rise. Constraint weighting assets allocation does not prescribe strict rules for timing portfolio rebalancing, but recommended rebalancing while assets classes deviate significantly from other original weights. And then finally is the dynamic assets allocation involves ongoing adjustment to the assets mix in response to market fluctuations and economic shifts, allowing for a more responsive investment strategy. That's it for today. Here some links and website. APM is Association of Project Management website. You can also look at Prince 2. I will recommend you look at Prince
Yes.
2 Foundation and 2, and also PMI
Okay.
Investopedia. So that's it for today. Thanks, Hatim, for joining me this morning. And
Yes,
if you
yes.
have any concern, questions, and issues, you can drop me an email at yasir@ukversity.co.uk.
Okay.
Also, you can visit your learning management system, or
Portal.
Moodle for,
Yes, yes, yes.
further books and materials. And any questions, concerns, or any issues so far?
No, no.
Okay, Hatim, thank you very much. I'll see you tomorrow at 10 o'clock.
Okay, 10 o'clock.
Okay.
Okay,
Yes.
okay.
Oh, sorry. Sorry. I mean,
You're
9
9
o'clock.
o'clock, right?
9
Yes,
o'clock
yes.
for our second. I
Right.
think so. What time will be there?
So the time difference is 4 hours, so it will
Oh,
be
4 hours.
1 p.m.
So
Yes, yes.
obviously, I'll see you 1 o'clock yours. Okay.
Right,
So
right.
thank you very much, Hatim. Thank you very much,
Thank
and
you.
have a good day. And bye
Thank you.
for now.
Bye, bye.